Narrator. For some, a hybrid approach might be the best bet. This involves investing a portion of your portfolio in individual stocks for potential higher returns, while also holding ETFs for diversification and stability. Narrator. Let's dive deeper into individual stocks. Individual stocks represent a share in the ownership of a company and constitute a claim on part of the company's assets and earnings. Investing in individual stocks can be immensely rewarding, especially if you've picked a winner. For instance, early investors in companies like Amazon and Tesla have seen their investments multiply many times over. But with high reward comes high risk. The value of a stock can fluctuate dramatically, and there's always the risk that the company you invest in could underperform or even go out of business. Moreover, investing in individual stocks requires a significant amount of research, time, and financial acumen. It's not just about picking companies you like, it's about understanding the company's financial health, its position within the industry, and the potential for growth. That's a wrap on individual stocks. In the next scene, we'll delve into the world of ETFs, a safer and more diversified investment option. Narrator. Now let's explore ETFs, also known as exchange-traded funds, in detail. ETFs are investment funds traded on stock exchanges, much like individual stocks. They are designed to track the performance of a specific index, sector, commodity, or asset. The beauty of ETFs lies in their diversification. Instead of putting all your eggs in one basket with individual stocks, ETFs allow you to invest in a wide range of companies, spreading the risk. Investing in ETFs has its pros and cons. On the bright side, they offer lower risk due to their diversification, are easy to trade, require less research and management, and are more tax efficient. However, the potential returns may not be as high as individual stocks, and there are management fees to consider. A good example of a successful ETF investment is the SPDR S&P 500 ETF, SPY, which aims to track the S&P 500 index. Investors in this ETF have enjoyed consistent returns over the years, mirroring the overall growth of the US stock market. That's a quick dive into the world of ETFs. In the next scene, we'll discuss the hybrid approach, which combines the best of both worlds, individual stocks and ETFs. Good narrator. Now that we've ventured into the worlds of individual stocks and ETFs, let's look at some successful examples of the hybrid approach. Our first case is of a savvy investor who chose to split their portfolio into a 70-30 ratio. 70% of their investment was placed in the SPDR S&P 500 ETF, SPY, ensuring steady growth and diversification, while the remaining 30% was allocated to hand-picked individual stocks. This approach allowed them to reap the benefits of both diversification and high growth potential. In the second example, an investor decided to invest 50% of their portfolio in ETFs, focusing on sectors they believed would perform well, such as the tech-focused QQQ ETF. The remaining 50% was invested in individual stocks with promising outlooks like Tesla and Amazon. This diversified yet targeted approach led to an impressive return on investment. Finally, a third investor took a more conservative approach. They dedicated 80% of their portfolio to broad market ETFs, ensuring stability and lower risk. The remaining 20% was used to invest in high-potential individual stocks, providing a chance for higher returns. These case studies show the potential of the hybrid approach, combining the security of ETFs with the potential high returns of individual stocks. Remember, the key to a successful investment strategy is balance and understanding your risk tolerance. Narrator. Investing can indeed be a tricky business, and even with a robust hybrid approach, there are potential pitfalls to avoid. Let's discuss some common mistakes investors often make. Firstly, many investors often overlook the importance of diversification in their individual stock selection. They get enamored by the high growth potential of a few companies and put too many eggs in one basket. Remember, even within your individual stock allocation, diversification is key to managing risk. Secondly, investors sometimes fail to rebalance their portfolio periodically. Your ideal ratio between ETFs and individual stocks might shift over time due to market conditions, personal risk tolerance, or changing investment goals. Regular rebalancing is essential to ensure your portfolio stays aligned with your strategy. Lastly, some investors let their emotions drive their investment decisions. It's crucial to remain objective and stick to your plan, even when the market gets turbulent. Don't let fear or greed derail your investment strategy. Avoiding these mistakes can help you become a more successful investor, maximizing your returns while managing your risk effectively. Remember, a good investor is not just about picking the right investments, but also about avoiding these common pitfalls. Narrator, finally, let's dive into some tips for successful investing. These tips will help you navigate your investment journey with a hybrid approach more effectively. Firstly, stay informed. Keep up to date with market trends, financial news, and the performance of your chosen stocks and ETFs. This will help you make informed decisions and potentially spot opportunities or risks early. Secondly, start small and gradually increase your investments. Don't be in a rush to invest large amounts in individual stocks or ETFs. Start with what you're comfortable losing, learn from the experience, then gradually increase your investments as you become more confident. Thirdly, have patience. Investing is a long-term game. It's about the compound interest and growth over years, not days or weeks. Don't expect immediate returns, and don't panic when the market dips. Stick to your plan and give your investments time to grow. With these tips, you're well on your way to becoming a savvy investor. Always remember, the goal is not to get rich quick, but to build wealth steadily over time. Narrator. In conclusion, both individual stocks and ETFs hold their unique advantages and disadvantages. Individual stocks can offer higher potential returns and more control, but come with higher risk and require more management. On the other hand, ETFs offer diversification, lower risk, and ease of management, but may have lower returns and management fees. Narrator. Thank you for joining us in this exploration of individual stocks and ETFs. We hope this has provided some clarity and will assist you in making informed investment decisions. Until next time, stay financially savvy.